I just had a quick one. What was the attendance code again? I didn't catch that.
7711. Yep. Okay. All right. Any other questions? Okay. If not, then let's talk about chapter 11. Any questions from your own studying and reading or from watching the video? It is quite a bit of information jammed into one chapter, but it is the backbone of the rest of this semester. So you got to make sure you understand this chapter before you can move on. Yeah.
So, Brother Ma, I do, just for clarification so I can understand.
Yeah.
So arbitrage is when investors or banks um, are just watching financial markets and are trying to gain profits just through trading currencies. Is that correct?
Correct. Yeah, and you're taking
Okay.
advantage of any difference in, if you're talking about arbitrage with in the foreign exchange market, you're trying to find any difference in exchange rates that exist in different markets. If you're talking about the interest arbitrage, that's when you take advantage of different interest rates offered in different markets, right? But either way, you're finding some difference in different markets that can be exploited for profit.
Okay. Perfect. Thank you.
You're welcome.
And one more clarifying thing.
Yeah,
Regular arbitrage, you're trying to buy and sell as close to simultaneously as possible, right?
right. Yeah, because those rates can change very quickly, and sometimes they only last for, seconds instead of minutes. So if you don't simultaneously do the transactions, then your window of opportunity can close very quickly.
Brother Ma.
Excuse me, just had a tickle in my throat. All right, Stephanie, did you have a question?
Yes. So you mentioned in the video a couple of helpful equations. Could you go over those again?
Are you talking about the equations for
Like the
the
one for
premiums and
nominal, the one for the nominal exchange rate versus the real exchange rate. Am I getting that
okay,
like that?
yeah. So let me, I forgot to log in with my alter ego here. Give me a second so I can log in and share the screen with you guys. Yeah, so I guess while I do that, the idea behind um, that is that your exchange rate is um, about your changes in your currency value, right? But um, the change in your currency value is also impacted by your price level changes domestically. So that's why, we want to capture the exchange rate fluctuations controlling for any inflation in your domestic economy. And that's what essentially is going on. And so let me find my notes and then share that screen with you. Okay. All right. So share, start. Okay, can you guys see the screen now? Okay, all right. So this is the equation um, we talked about. And we said real exchange rate is the nominal times the ratio between foreign and domestic price level. So what it is doing is here you're capturing the impact of any inflation that has on the value of your currency, right? So I walked you through an example in the video that's shown right here, but essentially normal exchange rate that you see reported online or at um, Wall Street Journal is the nominal exchange rate right here. That's what's reported. Okay, but if you want to find out what actually has happened to your the value of your currency, then you add in this ratio between the price levels of the two currencies, two countries, and then the end result will tell you the change in your currency after having controlled for any inflation impact. So that's the idea behind it. Is that what you're looking for, Stephanie, or you want to walk through another example? Stephanie? Can you guys hear me okay? Okay, all right. Oh, Stephanie can't hear me, I guess. Everybody else can. Mm, yeah, can you hear me at all, Stephanie, or just not clear? Okay, let's see. Oh, I just lost her. Did she log off? No. Okay, well. Okay, any other questions while we wait for Stephanie to log back in? I guess she must have had some internet trouble.
Yeah, can you do another example of it, just for clarification purposes, of the nominal
Okay.
exchange and real exchange rate?
Yeah, hold on one second. Let me admit Stephanie. Okay. And let's wait until she gets in, and then I'll ask. Okay, Stephanie, you're back in? Can you hear me now?
Yes, I can hear you. Thank you.
Okay, good. Yeah, you must have had some kind of connection trouble there for a second, huh? So anyway, just now when you were logged off, somebody asked me if I could do another example to walk through this formula, which I'll do in a minute, but I was trying to explain the kind of principles and theories behind this formula, so it doesn't sound like you could hear me, so let me just run over that really quick again, then I'll do an example. So the idea of real exchange rate is that, this the normal exchange rate you see reported is this nominal exchange rate right here, right? But we said the value of your money is not just affected by the foreign exchange rate market, but also price levels in your own economy. So if you want to look at what has actually happened to the value of your currency in relationship to another, you need to not only consider the nominal exchange rate, but also, okay, the ratio between the two price levels, what has happened to the price levels in the two different countries. Okay, so overall, that means your real exchange rate is really the value of your currency against another having adjusted for inflation. That's the idea behind it. Does that make sense? Okay, so
Thank you.
yeah, yep. So now, if you guys want to do another example, so let's get some. Okay, so again, the formula is real, okay, exchange rate equals nominal okay times foreign price level versus domestic. Okay. Come on. I did not want to talk to you, Siri. Sorry. Yeah. Wait, can you guys still see my screen, or did it die? Oh man. Okay. I just accidentally clicked on Siri somehow. That killed my screen share. Okay, I'm back, right? All right, good. Okay, so let's say that if we look at let's do from China's perspective, it's easier. So if we look at the ratio of yuan versus the dollar, okay, let's say in 2019, okay, it was 6.8 yuan per dollar. Okay. And in 2020, whoops, no. Okay, now it is 7.1 yuan per dollar. Okay, if you only look at this is your nominal exchange rates, right? If you only look at the nominal exchange rates, you might see the change being, okay, 7.1 minus 6.8 divided by 6.8 times 100, and that gives you the percentage change in the value of yuan. Okay, and it tells you that yuan roughly, let me use my phone to do the calculator. Okay, yuan roughly in this case, okay, depreciated by 4.41%. Okay, because now it takes more yuan than last year to buy American dollars, so that means the yuan depreciated, and according to your nominal exchange rate, it depreciated by 4.41%. Everybody with me so far? Right? Okay. Now, well, for simplicity, let's say last year, 2019 was the base year for both countries. So your CPI, okay, for China of 2019, let's see, was 100, and the CPI in the US was also 100. But this year, again, 2020, okay, the CPI in China, let's say they have, pretty big inflation, it's 125, and the CPI in the US, we have, pretty low inflation, let's say it's just 105, okay? If that's the case, then the real exchange rate between these two is now, okay, so for 2020, okay, your real exchange rate, okay, is 7.1 yuan per dollar, okay, times 125 sorry, in this case, 1 second. In this case, okay, the U.S. is a foreign country, right? So make sure you remember whose perspective you're looking at. So the U.S. is a foreign country because here, remember we said the standard way of reporting exchange rate is always how much domestic currency it takes to buy one foreign. So here we're looking from China's perspective. So that means it's 105 over 125. Okay, and if we do that, okay, let me again calculate that. 105 divided by 125 times 7.1. Okay, so that is, okay, 5.96 yuan per dollar. Okay, that's your real exchange rate for the yuan against the dollar. Everybody with me so far? Okay, now if you look at the the change in the Chinese yuan's
Sorry, Brother
value.
Ma, I have a question.
Sure, go ahead.
So in China, it's the 125 CPI, but you have that as the denominator, where in the first one, it's on top. Is that how it's supposed to be always? Is it alternates, or is it the lower?
No, it's always the foreign price level in the numerator and your domestic price level in the denominator. Okay, and so here in this case, we are looking at this situation from China's perspective because we're reporting the exchange rate as how many yuan per dollar, and so that means we're looking from China's perspective. Okay.
Okay.
Okay, so that's why, yeah, that's why 105 of US CPI is on top and 125 of China's CPI is on the bottom. Okay, that makes sense? All right, so now here then, that means the Chinese yuan's real exchange rate actually was 5.96 of new value minus 6.8 divided by 6.8 and times 100, okay? And that gives you a, okay, let's see, 5.96 minus 6.8 divided by 6.8. Okay, so that gives you a negative 12.35%. So that means the exchange rate, real exchange rate actually decreased by 12.35%, which means the Chinese yuan, after you consider the impact of their inflation, actually appreciated by 12.35% against the dollar. Okay, so the reason behind this is saying, well, sure, now it takes 4.41% more yuan to buy a dollar compared to last year if you look at the nominal exchange rate. But considering that in China there was 25% inflation, okay, so there's a 25% inflation in China, but it only takes 4.41% more yuan to buy a dollar. So that means the yuan actually, you know, appreciated in real terms against the dollar. If it didn't appreciate at all, then it would take 25% more yuan to buy, or not 25% more because of the U.S. also had some inflation, but it would take, you know, somewhere about 15% more yuan to buy the dollar. But instead, it only takes 4% more. So that means in real terms, after you get rid of the impact of inflation on the value of yuan, just looking at what has happened yuan against the dollar without the impact of inflation, the yuan actually appreciated in this case. Okay, does that make sense? Does that help? Okay, any other questions?
Is it always 2 years compared against each other successfully?
Not necessarily. This way is just easier because here, by assuming 2019 is the base year, then in the base year, your nominal exchange rate and your real exchange rate is going to be the same, right? Because, you know, price level, foreign and domestic here are both 100, so 100 divided by 100 gives you just 1, so real equals nominal. So this is for convenience, but you can compare across multiple years. You just have to calculate the real interest rate for those 2 years before you can make any conclusions. You can say, well, in the last 5 years, okay, real exchange rate for the Chinese yuan has changed by this much. You can certainly look for more than 1 year. I'm just trying to keep your life a little bit simple by giving you this specific situation. Okay. All right. Okay. Any other questions? Everything else made some sense, especially with the forward contracts and premiums and discounts. And
could you actually go over, I guess, how forward contracts work?
okay, so a forward contract is just a contract you can sign with usually a bank to lock in an exchange rate now for a future transaction, right? For example, if you a couple of needs are there for this type of contract, right? One, we talked about in the video that if you own a business and you are expecting a transaction to happen in you know, a certain amount of time into the future, let's say 6 months from now, Walmart has to pay China you know, 20 million, their Chinese suppliers, 20 million yuan for the toys for Christmas time, right? So they're expecting, you know, the contract to be fulfilled, let's say in August. So, well, exchanging for 20 million yuan, now they know how much it would cost, but if they wait, if the yuan appreciates, then that means it'll cost Walmart more dollars to exchange the yuan. So to protect themselves from that kind of bad luck and that kind of risk, they can go to Bank of America and say, hey, Bank of America, how about we sign a contract right now saying that 2 months from now, we will buy 20 million yuan from you at the rate of 6.5 yuan per dollar. Okay, that way, if the yuan appreciates to $6, you know, 6 yuan per dollar, or actually Yeah, that's right. 6 yuan per dollar, then we can protect ourselves against that risk, right? So that's one need. Another one, the actually more common need for futures contracts is when people do interest arbitrage, where they're trying to invest money in a foreign market for their higher interest returns, but like we talked about in the video, right, the higher returns will only work if the exchange rate doesn't move against your favor and against you and alleviate all the extra earnings you make, right? So let's say if you get, well, actually, the better way to do this is let's go ahead and open your supplemental homework and look at question number 2. Okay, so that is the one that usually I get most questions about on this supplemental homework, and I think if we do this one, the rest will be much easier for you. So instead of me walking through, making up an example on the spot and trying to explain this to you, okay, how about I put you guys into groups and give you a few minutes and you try to solve this together, and then after a while I'll bring you back and then we'll walk through that together, and I think that will work better. Okay, so let me put you into breakout rooms. Okay, so again, work on number 2 on your chapter 11 supplemental homework together. I'll give you 10 minutes and then I'll bring you back and then we'll talk about it together. Okay, see if you can solve it and use the formula correctly that way. Okay, I think you guys are all back, right? Now, I hope you were able to solve that. How many of you think you worked it out? Just show of hands, let me see. A few? Okay, most of you aren't sure. Okay, so let's talk about this and look at this, and hopefully I can help you guys walk through this. Okay, so the scenario, I'm looking at, let me find a good spot on my screen to put this so I can read it and without looking like I'm just looking away from you guys. Okay, so the scenario says, okay, here you have, first of all, the spot rate, okay, for your dollar, and euros is that it's 1.6 euros per dollar. Okay, that's your spot rate. Okay, and then it tells you that the annual interest rate for a 180-day deposit is 4% in the US and 10% in Germany. Okay, and then it says, well, explain how a US investor would use covered interest arbitrage to hedge against the risk of purchasing this 180-day bill in Germany, and then figure out what the forward exchange rate needs to be if the rate eliminates any possible profit, this U.S. investor could possibly gain from the interest arbitrage. Okay, so the first part, hopefully you understand now that because Germany offers much better interest rates, a U.S. investor will have the incentive to put their money in the 180-day German bill rather than the US one, right? Okay, and because you can earn quite a bit higher interest rate, and specifically, because remember, these 4% and 10%, these two are the annual rates. So that means in 180 days, roughly 6 months, you get 2% return on the US bond versus a 5% return on the German bond, right? Everybody with me? Okay, so always remember how you need to convert your annual rate to the length of your actual investment, and otherwise you'll get it wrong. Okay, so but nonetheless, that means if a U.S. investor puts her money in Germany, she could look at potentially a 3% higher return, right? That's the extra profit she could get from investing in Germany. So that requires that she will have to buy euros in the spot market right now so that she can purchase the bonds right now. But then she will sign a 180-day forward contract to sell euros and convert her money back into the US dollars, right? Everybody with me of what an investor needs to do in order to take advantage of that? Okay. Now, the 3% of extra return we're showing here, that is assuming if the exchange rate remains the same, right? So if the exchange rate, the value of the two currencies don't change, then sure, she can earn 3% higher. But the problem she faces is, well, in the 180 days, if the euro depreciates more than 3%, then she won't gain anything and she could look at a loss instead, right? Because she's going to earn euros for 180 days. And if during this process, euros depreciated and did so more than 3%, then she would actually lose money. That's the risk you face when you do interest arbitrage. So in order to make sure then you don't face this uncertainty, right? Then you can cover your risks by signing a forward contract. Now, this forward contract, okay, will not be at 1.6 euros per dollar because a lot of U.S. investors will be trying to buy euros now and sell euros in 6 months. So that will change the exchange rate in the forward market. And exactly how much, okay, is calculated based on what we're about to do, where we say, okay, well, what is the forward premium or forward rate is going to be if everybody's doing this to cover their uncertainty and their risks? And then the question is, well, the formula we know is the premium or discount on the forward rate, which it measures the difference between your forward and exchange rate, right? So this equals, we said, the forward rate, okay, minus the spot rate, okay, divided by the spot rate. And in your book, we specifically said this times 12 divided by number of months, because this is converting the premium and discount to the annual level. Okay, so you got to figure out how many months it is out of 12 that you're calculating. So this is the formula. Apply to this situation. We say, okay, well, there are two ways of looking at it. Okay, if you want to look at it from the annual level, then annually the difference here is 6%. Okay, so you can do 6% equals, okay, the forward rate, I'll just do FR for forward rate, minus the spot rate, which is 1.6 per euros per dollar, divided by 1.6 euros per dollar, and then times 12 divided by 180 days, which is 6 months. Okay, and then you can calculate what this forward rate needs to be. Okay, does that make sense? Everybody with me of how we got here? Okay, the second way to do this is saying, well, instead of looking at the annual rate, I already know that in 6 months it's going to be 3% different. So you can just get rid of this part. This part is just converting this premium to the annual rate. But if you get rid of this, then you're just looking at whatever 180 days bring you. You can say, okay, in 180 days, I know it's 3% that I'm trying to cover, and that is the forward rate minus 1.6 divided by 1.6, and that's it. No times this portion of 12 over the number of months, if you want to do the 3% and look at just at a 180-day level. Either way works, okay? And because the 12 divided by the number of months, just convert whatever length your bond is to an annual level. And if you just want to look at it for the time period it is for, then you get rid of that last piece in your formula. So both should give you exactly the same number. And here, if we were to go through this, okay, and you'll see that, let's just work on this this latter one since it's easier, right? So this, you just multiply 1.6 on both sides. Okay, this becomes 4.8% equals the forward rate minus 1.6. Okay, and then you just do, or 4.8%, you convert it to a 0.048. Okay, so that equals forward rate minus 1.6, and 1.6, not 1 times 6, okay? Then you just move 1.6 to the other side, or add 1.6 on both sides. You get the forward rate equals 1.648. So that means the forward rate needs to be 1.648 euros per dollar. Then that would completely kill any possibility of her earning extra profit from investing in Germany. Okay, so, and since this is a positive number here, okay, when you calculated all this, this is a premium, right? So the forward rate is gonna be higher than the spot rate because of the incentives right here, right? Everybody's trying to buy euros right now and but sell euros later, so your exchange rate with euros per dollar is gonna be higher, or another word, euros gonna decrease. Depreciate, okay, in the forward market. So that shows up as a premium. Okay, all right. Does that make sense at all? How to work through this, Weston?
So for the first part of the question where it asks us to explain how they would use covered interest arbitrage.
Mm-hmm.
So just to make sure I understand, the ideal thing would be to buy a forward contract with the terms being that it'd be 1.6 euros to the dollar still, right? Just keeping it at the current spot rate.
No, I mean that won't. So your forward rate rarely is the spot rate, especially when there's an interest differential like this. Okay, but if you can find a contract that is lower than this rate we just calculated at 1.648, then that means you still can make more profit by investing in German bonds. So you want to lock a rate in before it rises to 1.648, but you need to do the math yourself to figure out how high the forward rate is too high, right? If the forward rate is 1.65, then by signing that forward rate, you're actually going to lose money. Okay.
Okay.
So that's the point of how to look at this problem here. But you're right. The first part of the question, you say, well, a U.S. investor will want to buy German bonds, but in the meantime, she's gonna buy euros in the spot market, but then sign a forward contract to sell euros and buy dollars in the forward market. Okay, that's the operation that you need to describe, and then you calculate what is the highest forward rate that this investor is gonna actually pull the trigger on. Okay. All right. Yeah.
Question.
Mhm.
So that rate that we just calculated, can she go up to what that equals, or can she not even hit that?
You can. So at this specific rate, you're indifferent. You can invest in the U.S. or Germany. You get exactly the same return. So you're indifferent in this case. And since if you're signing this contract, you've locked this rate in. So you know exactly that you are indifferent, and so it's comes down your personal preference in that case. You still can, right? There's no loss at this rate, but just there's no extra gain either. Okay. Any other questions?
So basically, we're just saying that at this forward rate, earning 10% in Germany or 4% or whatever it was here it turns out to be the same amount of money either way.
Right, for 6 months anyway, right? Yeah, so it's indifferent. Yeah, this forward rate, this forward premium will make your investment in the U.S. versus Germany indifferent. Okay, and if the forward rate is in the market is any higher than this, then you will actually lose by investing in Germany. But if the forward rate hasn't risen to this level yet, then you still want to invest in Germany, and that will still help you make extra profit. Okay. All right. Did that help? Make sense? Okay. All right. Any other questions from chapter 11 about maybe, currency options or, speculations? We talked about a lot of different topics, so just want to make sure you're clear on everything before we move
Can
on.
you explain triangular arbitrage?
Okay. Yeah. So the three-way or triangular arbitrage or three-way arbitrage is when you can spot the exchange rate differentials among three different currencies, right? And let me just find an example I use in the video because it's going to be very difficult for me to come up with numbers on the spot to demonstrate this because, you have to convert things. So here, this is the example I talked about in the video, right? Where let's say right now you are looking at three foreign exchange markets and you realize that in New York City, £1 exchanges for $1.50. In Geneva, £1 is exchanging for 4 Swiss francs. But in London, okay, 1 franc equals half of a dollar or 50 cents. And if you can do the math very quickly, or you have, more likely you have a computer program that will flag you and say, hey, here's the exchange rate differential, then you can take advantage of this by simultaneously doing these three things I listed here, right? In New York, you want to sell dollars to get pounds. Let's say you have a $1.5 million and you want to sell that and buy pounds so you can exchange $1.5 million to 1 million pounds right here. Okay. In the same time, in Geneva, you want to sell 1 million pounds to get 4 million francs. And then in London, simultaneously at the same time, you want to sell 4 million francs, and at that exchange rate, you'll end up getting $2 million. So you start with 1.5 million, and by doing these three things, you end up with 2 million. That's how you take advantage of these three different currencies having different exchange rates. Okay. Did that help, Jacob? Okay, I know it's the same example, but like I said, it'd be very hard for me to make up examples that work out, on the spot. So that's why.
Lerma,
Yeah.
hypothetically, could you do this with more than 3 currencies?
You can, but of course, when you add one more currency, first of all, to be able to convert that in your head or using a program to spot the differentials will be harder, but also operationally, to be able to do more than 2 or 3 transactions in separate markets simultaneously to capture that before the window closes gets way more difficult. So in reality, I don't think many people attempt to do more than 3, right? Because it's not about, you can, as long as there's a currency, exchange rate differential, you can always make money. But to realistically operate in more than 3 markets and do simultaneous transactions, that's the hard part, right? And also, if you have more than 3 currencies, then that means you are likely starting to get into smaller and smaller currencies, and many banks and traders don't have necessarily large quantities of money ready to trade, because you'll have, for this particular case, you need to have dollars, pounds, and francs all ready to trade. You can't transfer the 4 million francs from Geneva to London before you sell it again. You got to have millions of each currency ready to go to make these transactions happen. So having more and more currencies involved, then it's less likely that you have enough to cover all your transactions to begin with, right? So theoretically, yes, but realistically, it's very difficult. Okay. All right. Any other questions from chapter 11? You guys are good? Okay. See, is Thomas still here? He joined late, and oh yeah, Thomas. So the attendance code today is 7711. So make sure you put that in. Okay. All right. If you don't have any questions, then don't forget your supplemental homework and your regular homework as well. That's also due on Friday. And then I will post a video on chapter 12, and we'll talk about 12 next time. And you do have the quiz on chapter 11 next time, so make sure you get all your questions resolved. And if not, reach out to me and I'll help you resolve it. Okay. All right. That's all I got for the day. Then we'll end a little bit early. Okay. See you guys. Yeah.
Thanks, Paul.